Hello again to everybody, and it is a good evening and not a good afternoon like it was for all of us when we tried to run the webinar this afternoon at 3 o'clock and picked up a host of, it looks like, internet or weather related problems. So here we are again with a recording, and it's nice to have you on board. I hope that you're all safe in your houses with your loved ones and your spouses who bring you tea and coffee when you're going to read this, or listen to this rather, should I say, instead of Netflix tonight. This is far more exciting, much more pleasant experience for you than Netflix. And of course your kids are being angels as well, so you're going to have a wonderful evening as soon as I've finished, which should be in about 2 hours from now. It's now 7:15 my time, and that's the plan for the day. I just need to say very quickly that the information here is as a result of my activities as chairman of the Payroll Authors Group of South Africa, which is an organization, a non-profit organization that represents all of the payroll companies in South Africa, the 35 of them. And the Payroll Authors Group sits between the statutory bodies and the payroll author group companies and also their clients, employers. So we have employers as members as well. And we deal then with SARS and UIF, Compensation Fund, Employment Equity Directorate, Department of Labour, to make life easier for payroll officers. So that's where it comes from. We also do a lot of work with SAID, so we have good relations with them, hence this webinar today. Just looking at the plan for the morning quickly, I'm just going to say a few words in a minute just about the concept of absence from work. But then I'm going to move through the various areas where there can be tax relief provided around COVID-19 situations. So the compensation fund, then employment tax incentive, pay-as-you-earn relief measures, UIF benefits, and then payroll administration. And sort of starting from the top and moving down, the information, I'm starting with the solid information. And unfortunately, as we go lower down, it gets more problematic. There's still areas of confusion around the UIF benefits. And between this afternoon's webinar, which didn't work out, and this evening's repeat for the recording, there have been some changes which I'm going to point out to you when we get to that place. So I just have to say that matters are still extremely fluid. There are daily, hourly even changes coming through. But I think we're at a stage where what I'm giving you is getting close to being the final information. Queries, of course, you can submit to SAID, and they will pass them on to me. Just before going through the introduction here, I just want to mention the concept of absence from work that I spoke about just now. Remember that there are two broad reasons why you're absent from work. The one is if it's authorized absence, and the other one is unauthorized absence from work. Unauthorized absence is what we used to call in my army days AWOL. That's when you just disappear, nobody knows where you are, and you get, taken to DB when you get back. But authorized absence is obviously a part of our lives. It is specified by the Basic Conditions of Employment Act, which focuses on now 7 types of leave. We used to have 4, but we have 3 new ones from the 1st of January this year, being parental leave, adoption leave, and commissioning parental leave. But the other 4 that we've had for a long time are annual leave, maternity leave, sick leave, and family responsibility leave. The point that I want to make is that the Basic Conditions of Employment Act has not been changed as a result of the COVID-19 virus. It's unchanged. So whatever you're familiar with in terms of granting those types of leave, how to pay for them or not pay for them, nothing has changed at all. And the same can be said around the Unemployment Insurance Act. That's the act that deals with benefits. It prescribes when, how, which, what procedure, and importantly, how to calculate the value of a benefit. That act also has not been changed. What we do have from that aspect, the unemployment insurance side of things, is that they have a new method of providing a benefit, which is not in the legislation. It's outside of it, but it is an official method, which we'll talk about later, and that's the Temporary Employer Employment Relief Scheme. And that's where there are still, unfortunately, some grey areas. But having said that about absence from work, which of course is occasioned by a layoff, we all know the history behind this. The National Disaster Declaration by the State President on the 15th of March, and then the lockdown on the 23rd, 3 weeks from the 26th of March to the 16th of April. We're all familiar with that. And just to say very briefly that it seems that South Africa moved quickly and efficiently and effectively, that we are ahead of a lot of other countries around the world, first world countries. And so far we seem to be doing well, although sadly there have been some deaths. I don't know on how the State President is going to bring the lockdown to an end. It's going to be an extremely difficult decision. I can only assume it will have to be done only based on very solid medical and scientific facts. Otherwise, you can open it too early and we just go back to where we were. But that's where we are. We're in a lockdown, which is another type of absence from work. It is a forced absence from work. It's not by legislation. It's by decree, one can say. It's underpinned by legislation. But it is a totally different thing from what any of us have ever experienced. Then in the bottom half of the slide, just a list of some of the types of legislation that have been changed very recently. And the red ones are pertinent to what I'm going to be dealing with today, because remembering that this webinar today focuses on the payroll tax aspects of the virus and the layoff, the shutdown. So this is focusing on pay-as-you-earn, skills, UIF, employment tax incentive, compensation fund benefits, UIF benefits, and not today, but we also focus on the employment equity. Those are the areas that the Payroll Authors Group focuses on, employment-related taxes. And this legislation, going down to point number 5, which is the Temporary Employer Employee Relief Scheme, that's under the UIF, that has been issued as a directive. And sadly, it could have been done better, but we have to deal with what we have. And then the last two items are from National Treasury and SARS. Those are the two bills that make the changes for our webinar purposes today, to personal income tax and to employment tax incentive. So there's no Gazette number there. I presume it was published through another process, and it was published on the 1st of April, as promised by SARS and by National Treasury, and a very solid piece of drafting and legislation. So that is the scope of the session. Let's start with the first area there, where the compensation fund got out of the blocks very quickly, and they published a regulation which provides the rules and the application around COVID-19 diseases incurred in the workplace. And you can see in the top part of the slide that this describes a process that the fund has to go through in order to ratify a benefit claim. So right at the top, you can see it starts with the concept of there being a COVID-19 free employee, which I'm not too sure how easy that is to determine, because we all know it has an incubation period. So when are you free and when are you not free? Then it makes a point which is critical for the fund, and that is that the disease must have been acquired during the course of employment, which normally would be in the workplace, but it can also be on business trips, either locally or foreign business trips, overseas trips. And of course, not much of any of that is happening at the moment, because except for essential services, none of us are on the road or in our workplaces. So this is just providing the correct basis of the legislation for the future. But obviously, occupational injuries and diseases means just that. The injury or disease must be occurred in the workplace and in the course of employment. It also talks to there having to be a chronological sequence from the work exposure to the start of the symptoms, I presume starting from when the employee was COVID-free. This is obviously important, not only for the individual themselves, but also to pick up who they've been in contact with during the exposure period, to be able to follow that up. And it's rounded off, of course, at the end, with there having to be a doctor's certificate, a reliable diagnosis of the COVID-19 virus, as per WHO, the World Health Organization. So that's the broad process behind the legislation approval of the disease. And then bearing in mind that the compensation fund is an insurance product, so one has to always with insurance base the premiums on the risk. What are the high risks, what are the low risks? And the compensation fund is no different. There are currently 102 subclasses at the fund, and all of the employers that are registered with the compensation fund are categorized into one of those subclasses, and then a percentage is allocated to each subclass, so it's a risk percentage, and that percentage multiplied by your total earnings for the year gives the assessment, the amount that you pay. So here we have a similar situation. They've classified occupations here into 4 broad areas, from very high to low risk. And you can see that very high, these are medical type people who come into contact with people who have COVID-19 virus. Doctors, nurses, paramedics, etc., mortuary, sadly as well. So that's a very high risk area. Also high risk is similar in healthcare, medical care services. Anybody working there is at risk. Transport, ambulances, mortuaries and so on, but perhaps not with the same degree of contact with somebody who has been infected. That's why they're in a high risk category. Medium, and here we're looking at the close contact issue within 2 meters. Frequent or close contact with somebody closer than 2 meters, in other words, with somebody who is infected. Medium risk if you potentially in that area, and then if there's little or no close contact, then you are in a low risk area. All very logical, I think. And then moving to the next slide, what are the benefits that they provide for now around COVID-19? First one there is temporary disablement. I don't know if this is a possibility from the disease, but they're certainly making provision for it. And if there is temporary disablement, then CF, which is the compensation fund, will pay up to 30 days on that one. But a different story as far as permanent disablement is concerned. There, each case will be treated on its own facts. Sadly, number 3 is death benefits, and here the fund will pay for limited burial expenses and pensions to the surviving spouse. Confirmed cases versus unconfirmed cases. Obviously, confirmed cases means that there has been a medical diagnosis, and from that diagnosis date, 30 days of benefit will be paid, whereas if it's an unconfirmed case, this would be self-isolation, self-quarantine, which is an arrangement between the employee and the employer. So there, the employer must continue to pay. It's not a confirmed case yet. The claims themselves, depending how you submit claims, the online or the manual method, they have now provided an international code. That's U07.1, as you can see on the slide, and that must be used. And obviously, I would assume that in time, we are going to get very valuable statistics coming out from codes like these worldwide. Good, let's move on and let's start digging into tax relief measures. And the principle behind the bills that have been issued on the 1st of April, the 2 tax bills, is underlining very clearly SARS's general change in their approach. And that is that they are going to be focusing very much on assisting small to medium businesses for tax relief. That's a specific area now for this matter tonight, because small to medium businesses don't have the same amount of finances available to carry them through this difficult period. So a lot of focus is put on assisting small to medium businesses. And then a broad area of focus for SARS for the future, probably getting stronger and stronger as we go on, is that they are going to do everything that they possibly can to help make life easy for tax compliant businesses, whereas they're going to do everything in their power to make life difficult for non-tax compliant businesses. So we're going to see this coming to the fore more and more in terms of the legislation in future, their computer systems, perhaps all of their procedures is going to be focusing on differentiating between tax compliant and non-tax compliant businesses. And the tax relief here that we're talking about tonight is focused on tax compliant businesses. So the money from the relief is going to benefit the employer, but obviously if the employer is in a stronger financial position, it's going to help the employer to save jobs, and that's obviously going to spin off down to employees. So that's what it's all about. Just to say that the legislation measures are effective from 1 April 2020 until 31 July 2020. So it's a 4-month period. I don't know if we can read any significance in the 4-month period. If there's, a fear or an anticipation that the layoff could be for 4 months, I doubt it very much. I think it makes just practical sense that the measures that they put into place have to run for a period of time. So it's more a matter of practical administration than an anticipation of how long the lockdown is going to be. There are two areas that I'm dealing with tonight, deferral of employers' monthly pay as you earn, and then expansion of the employment tax incentive. So, for example, I'm not dealing with the tax relief for provisional taxpayers because that's outside of the field that I operate in, which is employment-related taxes. Let's start with the first of those, which is the deferral of pay-as-you-earn liability. And you can see there are some provisos that this deferral is limited to qualifying taxpayers in the first place. And you can see just below it that qualifying taxpayers, here we see it again, are tax compliant taxpayers, being that all tax returns for all taxes have been submitted and that there is no outstanding debt for all taxes, with some exceptions around the outstanding debt side of things. Secondly, the qualifying taxpayer is an organization, an entity whose gross income for the year is less than 15 million. That would be small or medium sized. And by the way, there's some specific income types that are restricted when accumulating towards the 50 million. So one must look at the detail of that. And the year of assessment is for a year ending between the 1st of April 2020 and the 1st of April 2021. So going back to the top, that's the qualifying taxpayer who can benefit from this deferral of pay as you earn. And then the actual calculation itself is 20% of pay as you earn. Please bear in mind, this is not the skills development levy in the UIF. So even though this is going to be administered by the NP 201, which has all three of those taxes on it, it's only the pay as you earn portion that can be deferred. 20% of it can be deferred. And it can be deferred for 4 months again, starting from the 7th of May, which is the NP 201 in respect of April, and then ending up on the 7th of August, which is the NP 201 for the 31st of July. SARS are busy, flat out busy, revising the NP 201 to make provision on it for this deferral, to make it as easy and as simple. I'm not quite sure how it's going to work, whether there's going to be an automatic calculation or not, because I don't know if they'll be able to see if it's a qualifying taxpayer, and whether you have to declare some information on the 201 to say that you are a qualifying taxpayer according to those rules. So that's a broad area of change around the deferral. It has to be repaid, sadly, so it will be, or it has to be repaid in 6 equal monthly installments. I'm going to show you an example on the next slide of both the deferral and then the repayment. And that then starts in the 6-month period, August 2020 up until January 2021. So that is closing off this matter nicely just before the end of the 2021 tax year. Penalties and interest, well, this is the whole point. The deferral will not result in there being penalties and interest. So you won't pay penalties and interest on that 20%, which is being held back. But if the repayment doesn't follow the correct plan, the 6 equal monthly installments, then penalties and interest can arise there. So again, just to come back to MP201, it's going to be interesting to see what provision they make in the MP201 around the deferral and then the repayment as well. Here are some examples. So looking at the top table, this is the deferral, April, May, June and July. There are the pay-as-you-earn liabilities. Remember, this is only the pay-as-you-earn liability that can be deferred. There's the 20% less figure. The 80%, which is still payable, is reflected there, and that's just indicating, when that particular MP201 must be submitted by. So that's fairly straightforward. The total 20% deferral amount there is 120,000 Rand. So that improved the employer's tax or cash flow rather by 120,000 Rand over that 4-month period, which for small businesses is not to be sneezed at. Then the 120,000 Rand has to be repaid, which starts then in August, but on the 7th of September MP21 in respect of August, and there the 120,000 Rand is divided into 6 equal monthly installments of 20,000 Rand, and it gets paid off up until January, which is the 5th of February MP201. So I think that's fairly straightforward. We'll just have to see how the MP201 is going to be changed. And also, I think interestingly, I'm not too sure how they're going to indicate these deferrals on the statement of account. So those are areas that is still a bit of a wait and see at this stage. Then the other area of tax relief is around the employment tax incentive. Interesting changes here. Remember that the purpose of the Employment Tax Incentive Act is to allow government to assist the employer by sharing the wage costs of youngsters that the employer appoints into the business, and it's done on the basis of the concept of there being an eligible employer and qualifying employees. So that's the broad principle. The ETI is also claimed in the MP201 process. Whatever the amount of ETI is, it reduces the pay-as-you-earn liability in that month, and the employer then gets the benefit of that reduced liability, the cost of the pay-as-you-earn, in the month, basically, that the wages were paid for the young people. So very quickly, eligible employers, broadly, private sector employers that are registered for pay-as-you-earn. So government, municipalities, and so on are not part of ETI. Qualifying employees is the important part. In the ETI Act, in Section 6, it defines 7 tests which have to be applied to an employee in terms of the 4th schedule. So a normal employee, in other words, you apply those 7 tests, and if you tick the boxes for all of the 7 tests, then the employee qualifies to generate the tax incentive for the employer. Now, the 6 standard tests are things like the ETI had a starting date, which was October 2013. It excluded domestic workers and persons connected to the business. And then it dealt with identity. So ETI, there must be a South African ID document, an asylum seeker permit, and a refugee permit to identify the person. And then we get to the financial matters, which is the minimum wage, whichever is applicable, must be paid, and then less than 6,500 Rand remuneration per month. The last test is the age test. So the age group that ETI focuses on encouraging employers to appoint these people are those between the ages of 18 to 29 years of age. Now, with the exception of in 2018, this age test was relaxed for employers who have a business in one of the 6 special economic zones that were designated by Minister of Finance Kigaba in 2018. If that was the case, the age test fell away in those special economic zones, but for the rest of us, the age test continued. Now we are seeing a relaxation of the age test, and we're seeing it for 4 months. So it is not going to be applied, as we'll see on the next slide. And just bearing in mind, just to give you some financial figures, because we're seeing both a relaxation to the age test and also an expansion of the value of the ETI. Currently, we have this concept of qualifying months, which is months in which an employee qualifies in terms of those 7 tests. And we have a 50% benefit or incentive rather for the first 12 months and a 25% incentive for the next 12 months. And the maximum incentive over the first 12 qualifying months is R1,000, and for the next 12 months is R500. So just bear those figures in mind. That will maybe make more sense to you when we get to the figures as to how the value has been expanded. Right, so what has happened is that the age test has been expanded. So the other 6 tests that I mentioned quickly on the previous slide remain, and they must still be applied. But the last one, the age test, in the coming 4 months has been expanded, and the original test of 18 to 29-year-olds within those 24 qualifying months remains. That's unchanged. But you can also now have qualifying employees who are those 18 to 29-year-olds who have moved outside of the 24 qualifying month period. So they've done their ETI for 24 months. They're still 18 to 29, but they are now included for 4 months as qualifying employees, even though they're outside of those 24 months. And then just a very broad application here. Anybody, any employee that is, remember ETI is based on employees as per the 4th schedule, and that is all age groups 30 to 65. Now it seems a little illogical the way it's broken up here as far as the age tests are concerned, but we'll see on the next slide where we deal with the money that this makes sense, because they've classified the money according to those 3 categories that you see there. Right, and just to repeat that this applies from the 1st of April to the 31st of July, and it only applies if the employer was registered for pay as you earn on or before the 1st of March 2020. No doubt, this last requirement was put into the legislation to prevent fly-by-night companies being registered very quickly once these very beneficial new ETI amounts were known, and that organizations can try and fraudulently claim these enhanced benefits. So that is to prevent that. Good, let's have a look at the numbers and the comparison of the changes in that table. And the changes are in red to make it easy for you to pick it up. If you look at the table, then we have the monthly remuneration brackets down the left-hand side, and that's unchanged. We have broadly a 3-part formula to calculate ETI. There's a formula for the first R2,000 per month, then for remuneration from 2,000 to 4,500, and then from 4,500 to 6,500 per month, which is where ETI comes to an end, because the employee doesn't qualify if remuneration is above 6,500. Then there are 2 columns, the second and third column, which is dealing with the first 12 months in which the employee qualified in terms of those 7 tests. And remember that these qualifying months are not necessarily continuous periods of employment, because it can happen, for example, that the employee can qualify for 6 months, then a bonus is paid which takes the remuneration in the bonus month above 6,500 rand. The employee doesn't qualify that month, but that month is not counted as a qualifying month. In other words, the 12-month period at the 50% rate just gets moved on a bit. So that's what qualifying months are. And you can see there that the change is that there's an extra 500 rand being added on top of the existing formula, which is from 0 to 2,000 rand, 50% of the monthly remuneration. From 2,000 to 4.5, it used to be 1,000 rand. It's now 1.5 because the 500 rand is being added. And then we have a change to the formula where it tapers down from 4,500 rand to 6,500 rand as well in the bottom section there. And then moving into the third column, exactly the same principle, except that this is based around the old 25% for the second 12 qualifying months. Again, there's an extra 500 rand broadly that has been added on top of those formulas. One thing for those of you who are perhaps more technically minded, if a partial month is worked, in other words, let's say half of the month is worked, and the remuneration that is paid is in respect of half the month, then the ETI Act specifies that payrolls have to gross up the remuneration paid for half a month to be what it would normally be for full month, and then apply that full month's grossed up remuneration to the table. And then the ETI amount that comes out of that is then grossed down. So that grossing up requirement remains for these two columns, the second and third column, which means that the amount of 500 rand that's additional will be prorated if it is, for example, a half a month. It would be half of that. Then the interesting new one is a complete new category, the new age groups, which I mentioned on the previous slide. So these are qualifying employees who are 18 to 29, who are outside of the 24 qualifying months, and then qualifying employees age 30 to 65. Just to remind you that the word qualifying is used there to indicate that the employee still satisfies the first 6 of the 7 tests. Only the age test which is different, but the first 6 will have to be satisfied, and the employee is then the qualifying employee. So these are the tests from April to July, and there you can see, interestingly, there is no differentiation between the bracket of 0 to 2,000 rand a month and then 2,000 to 4.5. There's one figure of 500 rand, which spans from 0 to 4,500 rand. So it's quite interesting. If the qualifying employee earned 1,000 rand in that month, then there would be 500 rand worth of ETI. Quite a generous incentive. And then the principle remains like the other columns. Above 4,500 rand to 6,500 rand, there's a formula to which 500 rand has been added. Now for this last column, the expanded age test, if that qualifying employee, again, in my example, worked for half of a month, the grossing up requirements do not apply. So it's only for columns 2 and 3 that the grossing up requirements apply, but not for the new one. So very interesting, and bearing in mind that the incentive, again, in principle, goes to the employer. It's the employer's pay as you earn, which gets reduced. But as I said on the introductory slide, the stronger the employer is, the less likely that there can be job losses, company close downs, and the like. So it will be translated into a benefit for the employees of the company as well. Right, it's an interesting and quite effective way to get this incentive across to employers. So interesting how they've written on the back of ETI to make this work. Then another interesting area, or difficult area, shall I say, for the last, since 2014, 6.5 years almost, and that is the question of refunds or reimbursements. Remember, the principle of ETI is that the payroll calculates the ETI for the month, gives the total ETI value to the employer on a report, and then the employer takes that ETI claim forward when they complete their EMP 201. So assuming that the pay as you earn for the month was 100,000 Rand and the ETI was 80,000 Rand, it means then that the employer only has to pay 20,000 Rand. So the liability of 100,000 is reduced by the 80,000 Rand ETI. And that's fine. It works out very simply. The employer pays the 20,000 Rand and moves across into the next month. However, it's the other way around, where the pay-as-you-earn liability is still 100,000 Rand, but the ETI for the month to be claimed is 120,000 Rand, then you can only claim up until the pay-as-you-earn value, which is 100,000 Rand. So that means that the employer would not pay any pay-as-you-earn at all. The liability would be extinguished by the ETI. But there remains an amount of 20,000 Rand, which the employer is entitled to. Now, the way it works is that 20,000 Rand rolls forward. It's a carried forward amount, and it goes through to the next month, and it gets thrown into the calculation for the next month. And this rolling forward continues currently for 6 months, and the 6 months is linked to the tax certificate cycle, being a March until August first 6-month period, and the September to February second 6-month period. Now, the current legislation says that if you come to the end of the 6-month period, shall we say the first one, that's the end of August, and there's an amount of ETI owing to the employer, then at that stage, SARS will, having checked the facts and checking compliancy and so on, they will then refund or reimburse the amount owing at the end of August. And the same situation at the end of February, at the end of the second 6-month period. And we've had this since soon after the start of employment tax incentive in January 2014. And it's a problematic area, difficult for SARS as well as for employers, this carry forward amount. And what has been changed now, and only for 4 months in the legislation, is that the principle of only reimbursing at the end of each 6-month cycle has been changed, and SARS will reimburse for each of the 4 months at month end in order to get that credit, if one can put it that way, on the pay-as-you-earn back to the employer as quickly as possible to improve the employer's cash flow. So maybe if this works very well, and by the way, this only applies again to tax compliant employers, but if this works smoothly, which I hope it does, because this is a much better process than the old 6-monthly cycle, maybe we might see this becoming a permanent change. I don't know. I suppose I live sometimes in a very hopeful world, but you never know. Perhaps this will change things for the better in the future. So remember what's shown on the EMP 201, the ETI carried forward from the 1 month to the next month is the amount then of the reimbursement. Again, the detail of how SARS are going to reimburse the employer is not clear, but I think with a fair degree of certainty that SARS will then credit the employer on the employer's statement of account, and then it can then be applied from there. I would assume something in that line. Obviously, they're not going to pay out the cash, give a check out or something. That won't happen. So again, I think a very good and practical use of the Employment Tax Incentive Act as far as making use of the ETI vehicle. Good way of getting the money back. Right, now we're getting to UIF and we're getting to some of the more difficult areas. So there are quite a few slides here. I'm going to try and talk around these points here. Just to say, as I said earlier, that this is a moving target. It honestly moves hourly during the past 10 days. It's slowing down a little bit, but still, as I say, changes have been made, or apparently have been made, between 3 o'clock this afternoon, Monday afternoon, the 6th of April, and this evening at 7 o'clock when I started this webinar. So things have not yet settled down. There are areas that aren't clear, and I'm going to do my best to explain where I am fairly certain, and also to give you a warning where I'm not 100% certain, that you be aware of that. So remembering that, again, we have 7 types of benefits currently. These are specified in that Unemployment Insurance Act, which I spoke about earlier, the act that has not changed for COVID-19. And of those 7 benefits, 3 of those that are specified in the legislation, point 1, 2, and 3, potentially can be used around a COVID-19 situation. So, for example, unemployment, it can be that the company closes down and there's unemployment because this layoff is just too long for the company. They couldn't make it anymore, and there's a close down. So then employment would be used, employment benefits would be applied, and it would be based around the COVID-19 financial distress. Illness, of course, I'm going to cover illness in a bit more detail just now, but this could be COVID-19 illness. And then we have point number 3, the reduced work time benefit, which is a new category of benefit. It came into effect in January 2019, and I'm going to talk more about that. It's broadly based around short time. And the 4th one is not in the legislation. That's the Temporary Employee Relief Scheme, TERS, which, by the way, is not brand new. It's been around, I think it was about 2016, if memory serves me right, when this was brought out for the first time. It was just called TERS. Now it has been used again as a vehicle to provide relief around the coronavirus, and it is called, or identified now as, the C19 TERS version. So I'm going to talk about the concept of credit days just now. You can see on the right-hand side against each of those benefits which uses credit days. And importantly, just note that the last one, TERS, difficult name to say, but it's nice and short, the C19 TERS does not use credit days. But the importance of that and its relevance, I'll show you just now. Then, just broadly speaking about layoffs, there are, to my mind, and as far as I know, this is not in any labor textbook at all, but to me it just makes logical sense to differentiate between 3 types of layoffs. You have a permanent layoff, which is as a result of retrenchment. It could also be, which is not on the slide, as a result of liquidation, closing down. Those are permanent layoffs. And there's an unemployment benefit which can be claimed around those situations. Then point number 2 is what's referred to as a temporary layoff. This, broadly speaking, is based on short-time arrangements. So this is where the employer is in financial difficulty. Times are difficult, and usually the wage bill is a big part of the expenses of a company. And the companies then generally are faced with 2 alternatives. Well, besides closing down would be the 3rd alternative. But the 2 alternatives in terms of carrying on is either retrenchment of, say, a portion of the business, not retrench and close down the whole business, or moving on to short time. Those are the 2 alternatives. And in a process of proper discussion between the employer and the employees, represented by bargaining councils or unions, and where the facts and figures are put on the table and the alternatives are discussed, if the conclusion that that discussion comes to is that it would be better to move to short time, shall we say 6 hours a day instead of 8 hours a day, that being a better alternative than retrenchment. The employees agree that they would rather keep their job at 6 hours a day than stand in the unemployment queues. And if that's the agreement, then that short-time arrangement moves forward. The employer's total wage bill will be reduced because they're only paying out for 6 hours a day instead of 8. But of course, the employee's take-home pay is also based on 6 hours a day instead of 8 hours a day. And it is there that the reduced work time benefit, the RWT benefit, can be applied to fill that gap of the wage between 6 hours and 8 hours a day. Well-intentioned, but just to bear in mind, and I'll perhaps speak about it just now, that one must just bear in mind that the benefit values is again calculated using credit days. And once you've used up credit days to claim a benefit, then those credit days have been translated into money and they are reset to zero. You start again as far as credit days are concerned. And credit days is a big part of the value of a benefit, because broadly the benefit value is the number of credit days times a certain rate per day. That's what gives you the benefit value. So that is the RWT benefit, reduced working time benefit, based around generally these temporary types of layouts, short time. Then the last one is where we are now. It's a forced layoff called a lockdown, nice short word, and it wasn't put into place by way of agreement or discussion. It was enforced by way of decree and underlying legislation in the country, and done obviously only under those conditions. So this is a completely different animal compared to the other types of layouts, permanent and temporary, and there are broadly two types of benefits that could potentially be used to claim in the case of hardship around the forced layoff. And that is the RWT benefit, or the one that we're going to be spending quite some time on, the C19 TERS benefit. Right, so I hope that those principles are fine with you. Let's work away from them or on from them. And I think I must just now at this point spend a little bit of time on the calculation principles around a benefit. And it is not easy, this calculation, but starting with a component. Remember I said broadly there's two components to calculate a benefit. It's days, being credit days, times a remuneration rate per day, which is called the income replacement rate, the IRR. But it's quite a process to get to the IRR, the income replacement rate. But as far as credit days are concerned, the legislation now provides that one credit day accumulates for every 4 calendar days in a month, what they call a contribution month. In other words, a month in which a contribution was made. Now, the calculation and accumulation of credit days is not done in the payroll system. It's done by the fund. So when a claim comes in at that point in time, they will look back in the history to see which are contribution months, and they will then allocate one credit day for every 4 calendar days in each of those months in which there was a contribution. So the fund calculates it, and then that's part of the formula. So it's multiplied then by the income replacement rate, which is quite a complex matter to get to that. I'll try and explain it quickly for you. It's not in detail on the slide, but the starting point is to get a remuneration rate per day for the claimant. So to start and get that remuneration rate per day, the fund, if the employee's remuneration is variable, it fluctuates, then they will get an average remuneration over the last 6 months. If it's static, it's the same amount every month, then they'll just use the latest month's fixed remuneration fee. In the process of looking at the averaging and the last month, if the remuneration for the employee goes above the benefit limit, which is 17,712 Rand per month at the moment, then only 17,712 Rand will be used to calculate the average remuneration rate per day. So if 20,000 was paid, then the remuneration rate per day is based on 17,712. And this has caused quite a lot of confusion when we come to TERS, where people have interpreted this to be the maximum value. It's not necessarily the maximum value, 17,712 I'm referring to. It's what is used to get to this first starting point, the average remuneration rate per day. Because obviously, if you have total remuneration over 6 months, you divide that by the number of calendar days in 6 months. If you're using the last month's remuneration, you divide it by the calendar days in the month, and you get an average remuneration rate per day. Then you get what's called the income replacement rate, and this varies from type of benefit to type of benefit. It broadly, in certain cases, has a cross-subsidization effect in that it's a percentage that varies between 38% and 60%. If it is a high income earner, defined to be an income above the monthly limit, that's seen to be high income in UIF terms, then the 38% figure is used. If it's a low income, 60%. And there's a sliding scale in between those two figures. So that percentage is then applied to the average remuneration rate, and you get a daily benefit rate, I think it's called, after the application of the income replacement rate. And then, and also what that income replacement rate does is it makes provision for the fact that remuneration is taxable, whereas benefits are exempt. They're exempt in terms of section 10(1) MB, which I remember very well, so I had to look at it again the other day. So benefits are exempt from tax, whereas remuneration is taxable. And the benefit is obviously provide for the loss of remuneration, or the loss of income. So the tax effect is also taken into account there. So there we have it. That's credit days times that rate per day gives you the benefit value. And having translated credit days into money, the credit days are reset to 0. Remember that the fund bases the credit days calculation around the employee. It doesn't matter who the employer is of that employee. They link that record at the fund based on the employee's ID number, and credit days are accumulated. It doesn't matter who the contribution is paid by or who the employer is. Credit days are just calculated if there is a contribution in that month. So they get reset to 0 once used, and they build up over a 4-year period. And by building up at a rate of 1 in 4 over potentially a 4-year period, you can end up with 1 year's worth of benefits, 365 days, if there was no claim made during the course of those 4 years. Because if there was, in certain cases, the credit days would be reset to 0. Now, that's a broad principle around credit days. However, there are some types of benefits which don't make use of credit days to calculate the value of the benefit. And there they are there for you. Maternity, it's a fixed period benefit. So they don't need to know what the credit days are, because the period of the benefit is defined. 4 months times 4.33 weeks a month is 17.32 weeks, which is 121 days. So that's the number of days that are used in the formula to calculate the maternity benefit. Parental leave, the new one, along with adoption leave and commissioning parental leave, that started on the 1st of January 2020. There the period again is defined. It's 10 days. Adoption leave, commissioning surrogate mother leave, 10 weeks times 7 calendar days equals 70 days. So those 4 types of benefits do not make use of credit days. Therefore, credit days are not reset when these benefits are calculated. So it means that if a lady who has 100 credit days available to her before going on maternity, and having returned from maternity becomes retrenched, those 100 credit days are available to her still. They don't get reset to 0 because she was on maternity leave. So it's actually a very wise and fair application. Now, the last one there, which is different, and this is where there's still some uncertainty, and we'll come to this just now when we deal with specific fields on the spreadsheet that must be submitted for the TERS application. The understanding that I have is that there are broadly three periods, or two periods of days which can be used for the calculation of the benefit. The one period is 21 days, which would be for the full lockout period, and the other one is 16 days, 1 April to 16th of April. Now, I must just perhaps talk a little bit around this. The assumption, and broadly, I think there's no reason why it could not be that there could be a 10-day period if that's what the employer declared, because maybe they carried on doing business for some reason into the lockout period. So I think it's possible. That's why there's some uncertainty around this. But the difference, or the rationale behind the difference between the 16 days and the 21 days is that the fund or whoever was doing the thinking here thought, well, okay, it is possible then that a portion of wage is still paid up until the end of March, in which case the employee has been paid, shall we say, 5,000 Rand for that last period in March. Therefore, when a claim comes through, then the period that, or the number of days that gives value to the claim should not include the period in which money was paid. So then they're looking at only the 16 days because money was paid up until the end of March. Alternatively, and as we will see, if the full 21 days is declared, it seems to me that on the spreadsheet, the amount of money that was paid in respect of that period of 21 days has to be declared on the spreadsheet. So that same 5,000 Rand is declared, that the period used is 21 days. The benefit is calculated using 21 days, but then the 5,000 Rand is offset against the value of the benefit. I'm trying to simplify, what is quite a complex principle and calculation, and which quite honestly is still not 100% clear and final the way I read things at the moment. But that is the thinking, or that was the thinking on Sunday, which is a day ago. So keep that in mind when we come to the spreadsheet just now, because we're going to come back to those dates. But that's the principle around how to calculate the benefit value. It is days times a rate per day, and there are two types of days, credit days and fixed period days. Right, let's just look a little more specifically at the illness benefit, which, as I said earlier, is unchanged in the Basic Conditions of Employment Act, but there is a change around the application of what is called the illness benefit. So it's sick leave in the BCA, and it's an illness benefit for unemployment insurance. And the two scenarios now, or the new scenario, should I say, is in point number 1, and that is self-isolation or self-quarantine. So the individual is not ill, but for good reasons, the individual has decided, no, they had better isolate themselves. They don't want to get more sick, and they don't want to make other people sick, which obviously is a very good thing to do. Now, if that's the case, and this individual is an employee, so there's an employer and employee involved, then the self-isolation must be confirmed in writing between the employer and the employee. And if there is such a confirmation, then that confirmation letter, document, can be used in an application for sick leave instead of the medical certificate. Because there can be no medical certificate because the individual is not sick. They are just worried and doing the right thing. So the letter from the employer stands in for the medical certificate. And following from that, a normal sick benefit under the normal rules around sick benefits that you're probably familiar with will be paid, and it will be paid then for the self-isolation period, which is 14 days. So a benefit can be paid around self-isolation in terms of the COVID-19 virus. So please be aware of that. Point number 2 is really just a normal illness benefit, and that is when the person has become sick, and obviously then diagnosis, medical certificate is required, and the application for illness leave as normal, just like any other illness. Now, bear in mind that the illness benefit calculation uses credit days to calculate the value of the benefit. Therefore, whatever of the credit days that we use to calculate the money is reset to 0. So having claimed the benefit, the credit days get less. Keep that in mind. Then we get to the reduced working time benefit, which I spoke about quite a bit earlier, designed for short-time arrangements where the employer, because of financial stress, has, under agreement and discussion, has moved from 8 hours a day to 6 hours a day, or from 3 days a week to 5 days a week. So a properly discussed and agreed short-time arrangement. Now, I touched on it just now. Let's just talk about 6 hours a day instead of 8 hours a day. The employee who is now getting less wage take-home can claim the reduced working time benefit. No problem, it's available to them. Payrolls have to declare a termination reason code of 17 to indicate that it's short time, and the benefit claim, can then be made. But remember that the principle, and this is the principle across all of the benefits from the fund, is that the contributor who's claiming the benefit can't make a profit on the benefit claim. So in other words, relating it now to 6 hours of wage and 8 hours, the value of 6 hours of wage plus the value of the benefit cannot be more than the value of 8 hours of wage. So the legislation entitles the fund, when there is top-up remuneration, for example, for maternity, they can look at what the benefit value would have been. The employer has to declare what the top-up remuneration value is, and then the fund is entitled to reduce their benefit so that the benefit value plus what the top-up remuneration is puts the maternity lady back in the same place. And the same principle would apply to the 6 hours and 8 hours a day. So there's an adjustment that the fund is entitled to make if additional income or remuneration is paid over the period applicable for a benefit. So having claimed a benefit value for 2 hours of wage and using credit days, those credit days are gone, whereas maybe they could have been used to claim a bigger benefit value a year down the line if the individual was then unemployed. So it's something just to bear in mind in these short-term discussions. Also, part of those discussions must be the reality that not every employee in the business has the same amount of credit days. Obviously, it's dependent on service and contributions. So one employee could have 10 days, another one 50, another one 100, another one 200 credit days. So potentially the value of the reduced working time benefit can vary between different employees because they each have a different number of credit days. So just points to take into account. And then this benefit uses that sliding scale, that income replacement rate that I spoke to you about earlier. Good. I think I've covered all of the points there. Just to say at this stage, before we move on to the difficult one, which is the TERS arrangement, that it is possible that the reduced working time benefit claim can be used for the lock-off period. Because remember, you could be locked out for 21 days, which could be seen, to be a short-time arrangement, like going from 5 days a week to 3 days a week. It's just happening in a different manner. So it is possible to use a reduced working time benefit claim around the lockout period. But I think that despite the administration difficulties around the TERS application, that a better result is achieved with the C19 TERS. But it is possible, and I get a lot of queries around it. You know, can you use this one or must you use that one? The answer is you can use both, it's your choice. Or you can use either. You can't use both at the same time, obviously. You can't claim twice in different ways. But you can decide it's the employee's decision whether to go for the RWT benefit claim or the C19. But I think everything indicates that the C19 TERS around the lockout situation is a better way to go. So that's where we are. Let's start with this difficult area. And I just repeated the point I made earlier, and that is, I think that it should be used and not the RWT benefit around the lockout relief. Now, I said again earlier that the TERS has been around, I think it's about 4 or 5 years, and unfortunately, the early documentation that was released by the fund in the form of guides were very confusing, and they seem to change every 2 days, and you get a new version, and they were, sadly, I'll say this with respect, but they were not very well worded. And those guides actually caused more problems than good. It caused an enormous amount of confusion. You can imagine if you look at one guide one day and then you look again 3 days later and it's different, you know, that puts you in a complete state of confusion. So that, you know, led to the confusion, which is being cleared up. I must say there's a lot of areas that have been clarified, but various opinions floated around, and it was not good for the process. Whereas the compensation fund and SARS were very crisp and clear, in my opinion. We still have these grey areas and confusion around this benefit. So when can you apply for the C19? Well, there's some broad principles. It's only for lockdowns that are as a direct result of COVID-19. So getting back to my earlier classification of layoffs, temporary layoffs, permanent layoffs, you know, which is total liquidation, total retrench the whole company, etc. And then the last one, which is the forced layoff by law, which is a lockdown. Only that last one can be used. It's around a lockdown circumstance that the C19 TERS can be used. No doubt many of you will have seen the email that you can send. Part of the email address is C19 TERS, and if you send that email in, you'll get an auto response coming back, which tells you that there are certain forms and a spreadsheet that must be completed. There's a memorandum of agreement that must be completed, which I didn't really look at carefully. I just printed it out, and there was a whole lot of paper. I think it must be about 20 pages long. And that's an agreement between the employer and the fund and a bargaining council as well, if there's a bargaining council involved with the employer. So that should be completed. And I'm not sure if that's still the case now, but in earlier versions of that auto response email, it stated, or somewhere it was stated, that if you have less than 10 employees, you don't have to complete that MOA. I would suggest that it might be worth your while, even if you have less than 10 employees, to just complete the thing. You want to get this process done as quickly as possible. You don't want hiccups and comebacks where they ask you for the MOA and you say, but I've got 7 employees, and it goes back and forth. Maybe if you can, just complete it and send it in. My assumption is just that it should make the whole claims process just go a bit more smoothly. And then lastly, one of the requirements on that auto response is, and it's included as an attachment, is a spreadsheet that must be completed with the details of all of the employees who have been locked down or locked out. Perhaps that's not the right term. It's strike terms. Now, again, and sadly, there have been different versions of that spreadsheet. So the spreadsheet that is attached as of today, and I can't speak about today because I've been busy today, but as of 2 days ago, that spreadsheet 2 days ago was different from the one 5 days before. And I think it was also different from the one 5 days before that as well. And this is sadly because the spreadsheet was not discussed. I can understand that these things were done under pressure by the Department of Labour, Department of Employment and Labour, rather, should I say. But really, it was just sad that they didn't take into their confidence organisations, particularly like the Payroll Authors Group, that represents the payroll companies, which have to provide an interface to be able to create a spreadsheet out of the payroll, that they didn't discuss it with us. Yeah, let me leave it there. So let me try and deal with the spreadsheet as best possible. And on the next slide, I've just listed some of the fields. I think this is probably only about a fifth of the fields on the spreadsheet, perhaps even less. But these are the ones that seem to give problems. And let me deal with them. And just saying that, you know, this is according to my knowledge as of tonight, which is now 8:20 on the 6th of April. And it can change. As I will indicate to you, it seems to have changed this morning. So, but let's start at the top. The shutdown dates from and until. And as I said earlier, the fund is of the opinion that there are only two periods of the lockdown, the shutdown, and that is the 21 days of 27 March, 27 March to the 16th of April is the ending date. That would be 21 days. And then 1 April to 16 April would be 16 days. That seems to be the expectation, but I think there can be circumstances where the lockdown period is different based on the nature of the business, based on circumstances. So I don't think that's a rigid conclusion that the starting date must be either 27 March or 1 April. The end date probably is always going to be 6 April. But I think it is possible that there could be flexibility there. And then the next field on the spreadsheet is called monthly remuneration. Now, there is a similarly titled field in the specification that payrolls must obey when we create that declaration file which contains all of your employees and which you email to the fund every month. The payroll has to calculate what we call UIF-able remuneration. In other words, it's remuneration for the month for the employee based on the definition of remuneration in the Unemployment Insurance Contributions Act. And very simply, that definition says that remuneration for UIF purposes is the same as remuneration for pay-as-you-earn purposes. In other words, the fourth schedule definition. But the big difference is excluding commission. There are one or two other minor differences, but that is a big difference. So that's what we call UIF remuneration or UIF-able remuneration. And or my understanding up until Sunday, when I was in discussions with somebody on this matter, that firstly, that is what it was. It was remuneration. And secondly, that we could use the last month's remuneration, last completed month's remuneration, which would be generally March's remuneration. Because remember that this application could be done very soon during April, and then the April month is not yet complete in terms of remuneration, because remuneration includes, you know, the overtimes and the commission, should there be any overtime commission in this lockdown period. But potentially the fund agreed that last month's remuneration could be used. Now, I've since received information that other opinions have been put out there, and that is that remuneration is not remuneration, which is, shall we say, wage plus benefits plus variable remuneration, that it is only the wage. Now, I find that a little hard to understand. If that is what they wanted, why they didn't call it wage or salary/wage, instead of calling it remuneration. But I just put that out to you as a warning. This has come from a credible source which has made this, given out this opinion, and apparently as a result of advice from Department of Employment and Labour. So I am a little confused about what should actually be included for remuneration. I thought I had certainty yesterday on Sunday, and now I'm not certain. So hopefully this will be clarified within a day or two. And then there's this question of what's called leave income. Now, that's just a very strange word to use. It leads to all sorts of confusion. I think that what was meant in the minds of the people who drew up the spreadsheet initially was that in circumstances where during the lockout period some pay was still paid, some remuneration was still paid, then that money has to be declared, which I'm fully aligned with, because the value of the benefit has to take into account that the benefit shouldn't compensate for a period in which the employee was paid. So it must be taken into account in the benefit calculation, as I explained earlier. So I think that that is what should be there. In other words, the remuneration that was paid during the period of the dates in points 1 and 2 at the top. However, again, I've been informed that there are other opinions that this is not the remuneration value, it's the wage value excluding the benefits and the variable remuneration and so on. So I think the principle is correct as I've explained it, but what the value is, whether it's the remuneration value or the benefit value, I'm uncertain. My logic tells me that it should be the remuneration value, because they're calculating a benefit around the principle of replacing remuneration that has been lost. And that's why they take into account whether it was taxable or not taxable, because the benefit is exempt, and that's where the income replacement rate comes into play, which is used, incidentally, for the calculation of the C19 TERS benefit. So in my opinion, it should be the remuneration portion that's paid during the period of the lockdown that you specify. That is what I think should be there, but I reserve the right to advance rapidly in reverse on this one, and I'll be following up on this first thing tomorrow morning. Then the last figure, which is confusing, is called, its description is the sector minimum wage. Now, the principle around declaring a minimum wage is fine. The principle is that should the benefit that's calculated for the lockdown period of, shall we say, 21 days, should that turn out to be less than the applicable minimum wage for the employee, then the benefit value will be adjusted to meet that minimum wage, which is a fair principle and a logical principle. It's fair to the individual that they shouldn't get less than what the minimum wage is that they can normally rely on. Now, the word sector was puzzling why that was specified, because wage regulating measures include sectoral determinations, bargaining council agreements, and when questioned why they specified sector only, it seemed to be that they are not going to be taking bargaining council minimum wage agreements into account, which again I find a little strange. Even more confusing, but maybe the way to go here, is the fact that since January 2019 we have a national minimum wage, and that national minimum wage has minimum rates, There are 4 exceptions to what then was the general rate, the 20 Rand, and those 4 exceptions were lower minimums for farm workers, for domestic workers, for a public works program, and the last one was for learners in terms of a skills development Skills Development Act learner. So there were 4 exceptions. Just recently, effective from the 1st of March 2020, so it's not too long back, a month back, we've had increases to the national minimum wage. So there was a 3.8% increase for the minimum wage across all of those wage areas. But that is immaterial, really. The principle is that there's a national minimum wage, and if the employer does not have a minimum wage that's applicable, they don't have a wage regulating measure, then my assumption at this stage is that because you don't have a minimum wage that's prescribed, that you put 0 into that field. And then my logic tells me that if there's a 0, then the fund must apply the national minimum wage rate, which also makes sense to me, that the benefit value can then not be lower than the equivalent national minimum wage. A little bit of confusion still, because there are differences, or there are different minimum wage rates. There's hourly, weekly, and monthly rates, and we're not quite sure whether we should put a daily rate, which seems to be the way we're going, or an hourly rate, or a monthly rate into that field. So again, still some ongoing confusion around that, what's called the sector's minimum wage. The principle is a good one, it's just the application in practice, the administration. Lastly, and in one of the late changes to the spreadsheet document, it wasn't in the earlier versions, they now ask for a bank account, and it is a bank account into which, should this TERS benefit application be approved, the total benefit value will be paid into that bank account. Now, it provides for 3 different bank accounts. It provides firstly for the employee's bank account, secondly for the employer's bank account, and thirdly for a bargaining council's bank account. So starting with that one, I wasn't aware of this until Sunday, that apparently some bargaining councils have set up agreements where the money will be paid to the bargaining council, and then the bargaining council will disburse that money to its members, which is the same principle if the money is paid to the employer, into the employer's bank account, which is the second option. And I would believe that that's the option that is most widely applied. If the bargaining council, in a properly discussed process, has got permission that the money gets paid to the bargaining council and then they move it forward from there to the members, well then I suppose if it's properly agreed to, that's fine. But I would feel a bit more comfortable if I was an employer, if the employer could see the money coming in and then see the money going out and be able to account for it. Now, there are some potential difficulties around the total of the money coming in and the total of the money coming out. It's been made clear that the fund wants to and will in some way audit to make sure that the employees get the money that they're entitled to, their benefit portion that they're entitled to. But there are issues which are still under discussion, and that is the fact that the employer is incurring expenses quite often, depending on the nature of the payroll setup, while this lockdown is in process, where they are paying not accounts, but they're paying contributions on behalf of the employee, like the employee's contribution to a medical scheme or the employee's contribution to a retirement fund. If there is no remuneration in the payroll because it's a lockdown, then there's no remuneration to withhold those contributions from. And if the pot must be kept boiling at the retirement fund and the medical scheme, then the employer has to pay for that money. So it's essentially a forced loan situation. And my assumption was that when the benefit money comes in to the employer, that the employer could then set off that expense that the employers incurred on behalf of the employees in complying with statutory requirements like retirement fund contributions and medical scheme contributions. However, there are opinions that this should not be so, and that if 100,000 Rand comes into the company, 100,000 Rand must be paid out without any set-off. So again, must be discussed and finalized. But which account number to use is another matter, which is different from what to do with the money that gets paid into it. And as I say, just to repeat, I think that in normal cases, that the employer's bank account would be the one used, unless, as I say, the bargaining council has got official permission that the money goes into their bank account. So I'm afraid that I thought that by this stage, after about 10 days of discussing the spreadsheet, that we would have absolute finality, but we don't have absolute finality. So this is work in progress. Then just to repeat that the C19 TERS benefit calculation is exactly the same as the benefit calculation for unemployment benefits and for illness benefits. It's exactly the same calculation in principle. The averaging is done up to the monthly limit of 17,712. There's an income replacement rate that is applied, a cross-subsidization. All of those things are used in the principle around these benefit calculations. And the last aspect of the benefit calculation is the use of credit days. Now, this specific benefit does not make use of credit days. It is going to use what the fund believes should be either 21 days or 16 days, which I suggest might be a different figure, but it's going to use a declared period of days or a declared number of days to calculate the benefit. So the result is that whatever days are used to calculate the value of this benefit, because credit days were not used and translated into money, therefore the credit days are not reset to zero, those days that were used. So this on its own just makes the use of the TERS benefit calculation a much better proposition than the reduced working time. The decision is up to you. Both can be used, as I said. But barring the spreadsheet calculations, which are the spreadsheet population, which is a difficult problem, and also that memorandum of agreement is quite a lengthy document. But otherwise, it seems like this is the way to go. And a last aspect of this, and this is around the adjustment of the value of the benefit, if there is some income paid to the employee during the lockout period. A directive, or what's called a directive, it's not a directive in SARS terms, it's just a notice, was issued by the Department of Employment and Labour about a week ago. It's in Gazette 43161. And clause 5.3 states that there will be no benefit paid if the employee was paid, or words to that effect. Now, what they meant is that there will be no benefit if the employee was paid in full, not a partial payment, a full payment. Because obviously then there shouldn't be a benefit, because the employee has got the benefit of receiving their normal remuneration, which brings us back to the point of remuneration versus wage or salary cost, as it's called there in certain places. So just don't worry too much about that. The principle is there in point number 4. If the employer does pay some money, it will be taken account in the benefit calculation. The employee can't benefit twice from that money. Right, that is the TERS benefit claim, the last sort of area here, and this is certainly a big moving target. When I was doing these slides early this morning, I just jotted down some points which had come to mind about the issues of running a payroll where there is perhaps no employees at all, so there's no income, there's no remuneration to be processed. What do you then do about the contributions to medical schemes and retirement funds? Is there some sort of a moratorium that maybe can be arranged with the fund to say, while we have a lockdown, a specified lockdown period, no contribution, but then how do you do it? Is it a pro rata amount? I don't know of any such arrangements. I'm just speculating here. But something must be done because those contributions must carry on, or else the company must liquidate itself and call it a day. Weekly payrolls, of course, even though there is no activity in the payroll at all, must still be rolled over. So there is aspects of payroll administration that must still take place. Loan repayments, employee loans, presumably there, because it's an issue between the employer and the employee, perhaps the best thing is that the employer is just going to take into account that the loan repayments will be frozen for the period of the lockdown. That might affect the interest calculations on the loan, but I can assume that, that's the most practical way to handle that one. And of course, during this period, there's going to be, if there is a total lockdown and there is no remuneration coming through, there's going to be nothing that is based on remuneration. So pay-as-you-earn skills UIF and no expanded ETI, that extra 500 Rand. So that is a little bit of a problematic issue to me, because that would have assisted the employer, particularly employers with a large workforce of people in that category, in that last column on that spreadsheet that I showed you, which are individuals from 30 to 65, and in fact 18 to 29, as long as they qualify in terms of the other requirements. And one of the requirements of those other 6 requirements, of course, remember, was that a minimum wage must be paid. If there's no wage paid, if there's zero paid, then you're not complying with the minimum wage. And then I assume that there's no qualifying employee, and there can be no ETI because there's no remuneration. But then there's no 500 Rand enhanced ETI either. So it's a little bit of a, what do we say in Greek, a tomaleki, I think is the issue. And having put up just 4 slides here, I think that if any of you are sitting out there and thinking about your payrolls, I'm sure you can add, very quickly another 5 from your organization, and all of those will top up to be a nice 100 areas of difficulty around payroll administration during this lockdown period. But I think that's enough for now. I hope I haven't depressed you. And when you get this what is it called, this recording, this video recording, then I'm sure you're going to be reading it over a nice glass or something instead of watching Netflix, and that you're going to have a lot of enjoyment and also perhaps a lot of interest in what has been said here tonight. So thank you, and go well.